Hello all. So glad you have come to join us on our webinar with Taxes in Retirement. I usually teach these workshops at the libraries and I rotate between Huntsville, Madison, Athens, Decatur Library and have a good group of folks that come and attend those. I am a financial advisor, been in business for over 26 years, have my office here in Madison. And I do these under the Society of Financial Awareness, SOFA, as you can see in the bottom right corner. And this is an organization, nonprofit, that is made up of professionals who donate their time to teach worksite workshops. And our goal is to stop financial illiteracy one workshop at a time. The number one cause of stress in the United States, one guess, yes, it is money. And a lot of it is just because of not being informed and knowing the rules and how things work. And so it is really important that we know the rules of the game. So I am so glad you're on this workshop. I think this will be quite an eye-opener as we go through this. I don't know what motivates you when you get up in the morning, but for me, it's my family. And this is my family, wife in the middle, Dina. And we have adopted 3 children. And Anna is the oldest, and this is her husband, Paul. And then Ben and James from Guatemala. And Anna has 1 son, so I'm a granddaddy, and that is Peter. And just love him to death. Tell you a quick story about Peter. At 4 years old, he's calling me Grumpy instead of Grampy. It's not coming out quite like we had expected, but that's fine with me. But we like to play this game called Sharky, where I'm a shark and he's a little boy that he's befriended this shark. And we go deep sea diving into caves and sunken treasures and all kinds of cool things and meet octopuses and other dolphins and other swordfish. And we just have this make-believe world. And he just loves it. Well, on Christmas Day, he was getting all these presents and he's opening up all these new cool gifts. And he gets done with it. And I'm thinking, wow, I'm going to get to play with all these toys with him now. And I got down on the floor to play with him. And he looked up at me and he said, Grumpy, can we play Sharky? And it took me back that here he has all these gifts and toys, and all he wanted was time with his Grumpy. And it really drove home what I already knew, but so vividly here in this example, was that money just does not buy happiness. Now, we need money, and we need to be knowledgeable about what we're doing and be disciplined in how we deal with our money. And ultimately, we need money to do the things that we want to do, but ultimately, it is not going to buy you happiness. My office is in Madison, on Madison Boulevard, if you know where Furniture Row is at Hughes Road. This is the building when we built it back in 2009. Life Course Capital is my business, and we've been there since 2009. This is the disclosures for the workshop. The numbers I'm showing you are as accurate as I possibly can have tried to make it. Our goals today. There were several changes made to the tax code back in 2017, right at the end of the year. And they were working frantically to get it just under the wire so that we could ultimately be under those new tax rules in 18. Well, some new rules came out in 19 with the Secure Act, and then some even newer rules here in with COVID-19, and I'll cover all of these today. Is this your expression when you're looking at tax reform and trying to figure out what your taxes are? Well, you are not alone, unfortunately, because Congress constantly keeps changing it, and it's a moving target. Right now we have these marginal brackets, and I'm going to be sharing numbers that are for married filing jointly. The single numbers are about half of these numbers, but just to be consistent all the way through, I'm using the joint numbers. So you're in the 10% tax bracket if your income is under 19,400. And then for the dollars that are between 19,400 and 78,000, you're in a 12% bracket. 78,000 to 168, you're in the 22. 168 to 321, you're in the 24. Up to the 32, 35, and ultimately in the 37% tax bracket. Now, here is an important question about understanding marginal taxes. Suppose you were at the top of the 12% ordinary income tax bracket and you earned one more dollar, such that you were now in the 22% bracket. What is the impact on your tax bill? A, my tax bill would go up substantially, or B, my tax bill would go up a very small amount. I wish I could see a show of hands of what your answer is for A or B. And the answer might surprise you is B. My tax bill would go up just a very small amount if that happened. Now, don't feel bad if you got this wrong, because of those that were polled, only 52% got this right. Half of the population misunderstand the marginal tax brackets and feel that if I go up into the next tax bracket, all my taxes are at 22%. But what really is happening is only the dollars that fall into that 22% bracket are taxed at 22 cents on the dollar. All the rest of the dollars at 10 and 12 and 0, they stay the same. You may have filled out a paper tax return several years ago, and when it calculated what your tax bill was, if you were somewhere between 0 and 19,000, then it said just take 10% because you're in the 10% bracket. If you're in 19,400 to 78, it would say add $1,940, and then it's 12% of anything over the 19,400. So that $1,940 is your 10% of the 19,400. And so it went. So you can see we are in a progressive tax. You end up paying a little higher sum tax-wise on the more dollars that you make. Here's a graphical way of displaying this. So this is higher income, and this is higher taxes. So you'll notice here some is at zero tax, and that is because of a standard deduction, which I will talk about here in a minute. And then it goes to 10%, 12, 22, 24, 32, 35, 37. Now, that's not very smooth, and we've got some pretty big jumps here from 12 to 22. That is a 10% jump. That's huge. And then we've got this one from 24 to 32, and that is an 8% jump. And if I had to do this, I would have smoothed this out a lot more consistently on these different brackets, but they weren't asking me when they were calculating this. So we have looked at a very important point, and that is, what is my marginal tax rate? And that essentially is, what is the tax for the last dollar that I earned? And that is important as we'll go through this. Now, capital gains and qualified dividends are taxed differently. Well, what's a capital gain? Well, we get capital gains from stocks. So if you buy a stock and keep it for a while and then it goes up and you sell it, you have a capital gain. Now, if you kept it for under a year, that would be classified as a short-term capital gain, and that's taxed as ordinary income. But if you hold it for over a year, when you sell it, that is a long-term capital gain, and it is given preferential tax treatment. Many stocks pay dividends, and many of those dividends are qualified dividends, and they get the preferential tax treatment as well. Well, the reason that the IRS has given this is to incentivize us to invest our money, because we can get a lower tax break on our investments if we are investing in stocks and real estate. Real estate falls in the same camp. Now, the tax brackets are, if you are somewhere between $0 and $78,000, you will pay a 0% capital gains tax. So all of your gains that you're making on stocks are free. But if you get up in the 78,000 all the way up to 488,000, you have to pay 15% capital gains. And if you get above that, you are paying 20% capital gains, significantly lower than your ordinary tax rate. So that is a huge benefit. Here's a tax map to show that: 0, 15, and the 20%. Now, let's look at deductions, exemptions, and credits. So what is better, a tax deduction or a tax credit? Yes, a tax credit is way better than a tax deduction. A tax deduction will lower your taxable income. Let's say you're in the 22% tax bracket and you have a dollar deduction, and that'll save you 22 cents since you're in the 22% marginal bracket. But if you get a dollar tax credit, it is dollar for dollar right off the bottom line of what you owe in taxes, and that is huge. Now, the standard deduction used to be about $12,000 for filing married jointly. So lots of people itemized. And if you have enough itemized deductions that will get you above that standard deduction, then you do this on Schedule A. Now it has been increased all the way up to $24,400. And that is huge. And so very few people are itemizing their deductions, just taking the standard. But if you do have enough itemization to get you above this level, the items you can use is your mortgage interest, charitable gifting, property taxes and state taxes. And if you are above 65, then it actually goes up closer to $27,000 for your standard deduction. So a lot of people were itemizing because of their charitable contributions, and now they can't get over the 24,400. Well, one trick is to lump all of your deductions for several years into 1 year. So you know, hey, I'm gifting, I don't know, $15,000, $20,000 a year to charity every year, but it's keeping me just below the level where I'm getting any benefit. One neat option is to open up what's called a donor advised fund, a DAF. And you can dump in a bunch of money into these funds, get an immediate tax break, but be able to invest the money in various mutual funds, have control of the money for years, and then each year say, all right, I want to give some money to this charity, and through the years, you'll ultimately be able to give away all the money to charity. But you get all the big tax deduction all in 1 year when you fund these things. And that is a powerful way to do this. If you have a rental house that you have depreciated down to zero, that you would love to get rid of, but it's going to kill you tax-wise, and you are charitably inclined, give it to a donor-advised fund. And they'll be able to sell the house, turn around, and there will be no taxes that you have to pay, and you get a charitable contribution. It is a double benefit, and it is huge what the tax savings could be in a situation like that. Exemptions. It used to be that each person in the family got a $4,050 exemption, so that would lower your tax rate, taxable income, but that is gone. But they've replaced it with something even better, a child tax credit for $2,000 per child. That's way better than a $4,000 exemption per person. So we've got all these tax credits over here, and the goal for these is to incentivize people to do certain actions. Now, a child credit, I'm not quite sure what they're trying to incentivize us. Have lots of kids because you'll get a $2,000 tax credit for every child. But the healthcare tax credit is one that if you're needing to go out and buy your own insurance, say you retired at age 60 and you're not one of the lucky ones that was working for the government or for a large corporation that will allow you to keep their health insurance, and you're having to go out and buy your own health insurance. It can be costly, $2,000 a month costly. But if your income is within a certain band, you'll get a massive healthcare tax credit. And filing jointly for a couple of, it's around $68,000 that your income needs to be below to get a significant healthcare tax credit. And so I had a client here, and we do taxes for a good many of our clients. And he was retired on an Affordable Care Act. And so we were doing his tax return, and he was expecting about $1,000 back. But he got over the 68,000 by about $500, and you fall off a cliff and you lose the entire healthcare tax credit. He had cashed in an annuity during the year and hadn't told me, and his income got just over the limit. And here we are in March. What do you do? I mean, the year's done. And instead of getting $1,000 back, he was going to have to pay $11,000 to Uncle Sam. This was a $12,000 healthcare tax credit that he was about to lose because his income had just gotten up too high. And so Bob hadn't worked, and so he had no W-2 income. We couldn't do an IRA contribution. So I said, Bob, do you have a high deductible healthcare plan? He says, I don't think so. I said, well, this is worth doing because this is one of the few things you can contribute to after December 31st. So he called, and then he called me back and he says, they're telling me I've got a high deductible healthcare plan. I said, wonderful, we're golden. Here's what you do. Go to this website, open up a health savings account, drop in $2,000, and we are golden. And we did that, and it saved him $12,000. So this is really important that we know the rules on this. Earned income tax credits. If your income is low enough and you've got kids, like if you have $50,000 income and you have 2 children, you will actually get paid by the government. Never mind paying any income taxes, they will pay you under this earned income tax credit. Then the education credits, when you got kids in college, you know how expensive that is. First couple of years, you can get as much as $2,500 back per child in those first few years. Then it drops to about $1,000 to $1,500 for the subsequent 2 years. Then there's the Savers Credit, and this one very few people know about. And if your income's low enough and you put money into an IRA or a 401k, you can get some money back, 50 cents on the dollar. Here's an example to show that. So here's a couple making $38,000 and they're in retirement. And so their standard deduction is $24,400, but they're over 65. So you get an additional $1,300 a piece, bringing it up to $27,000 is their standard deduction. Well, he was working. You have to have W-2 income to be able to contribute to an IRA. So he had like a Home Depot job or something like that, and he put in $2,000 into his IRA. Well, when you deduct $27,000 and $2,000 from $38,000, his taxable income is down to $9,000. And so he's in the 10% tax bracket, so that would be a tax bill of $900. But his income was low enough, and he did an IRA that he could get 50 cents on the dollar for his IRA contribution and get a $1,000 tax credit. which totally wipes out his $900 bill. And so he was at zero taxes that year because he did this Saver's Credit. And remember this, especially in your kids, just as soon as they get a new job or working while they're in college, they can do an IRA and they can get a nice tax credit like this as well. So deductions will push our tax map to the right. In other words, more dollars will be at a zero tax, and versus a tax credit will actually wipe out part of our tax bill. All right, now I want to switch gears for a minute and talk about something a little different. Being a financial advisor, my goal is to help people in retirement draw an income without running out of money. And that is easier said than done because of the sequence of returns risk. So here is an example of a 40-year-old getting ready to save, and he's got $100,000 to put into the investments. And on the left side over here, he's pretty unlucky in that he ends up with 3 nasty negative years at the beginning, minus 12, minus 21, minus 14%. And his $100,000 drops all the way down to $59,000 in his first 3 years. But he hangs with it, and he ends up with some decent years and has a couple of negative years every now and then. But then right at the end has 3 gangbuster years, up 25, up 18, up 29. And he ends up growing his $100,000 to $684,000 by the time he turns 65. Well, what happens if we were to reverse all of these numbers? So here the 29 is now the first year, and then the second year, 18 is the second year, and so on. And now we have the negative numbers here at the end. Well, lo and behold, we end up with exactly the same amount. So it doesn't matter the sequence of returns while we are accumulating wealth. So all the time that we're working and growing our money, the up and down swings are not necessarily important. But now we hit 65 and we want to draw an income from the $684,000. So we go from 66 all the way to 90. Now look at the blue column first, and all we're doing is repeating these numbers again. This is an average of 8%, and so now we have the 3 strong years right out the gate, and we've got the 3 bad years here. And we determined we want to pull a 5% draw. And so we're going to start here drawing $34,000 a year, and then we're going to adjust it for inflation. So we're going to get raises all throughout this period of time. Will our money last? Well, not only did we last, but by the time we have pulled all this income and we've made it to age 90, we've got $2.6 million to leave our kids. Is that not amazing? Well, let's flip the numbers and see what happens. So you retire and you're drawing this $34,000, and right off the bat, boom, 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 we drop for 3 years in a row. Our dollars drop to 318,000. Now we're drawing over 10% of our portfolio because we've dropped in half. And we have some good years in here, but some negative ones, but it cannot catch up. And look at what happens. By age 82, we have run out of money. Whoa, what a huge difference here that we have experienced. Same numbers, we just reversed them. And this is a real risk. This negative 12, 21, and 14 is very, very similar to what happened in 2000, 2001, 2002. It dropped 10%, 11%, and 22%. It dropped 48% over those 3 years. And then the market took off in '03. We just barely made a new high. And then here comes '08, and it dropped 56% decline. And if you were one of the unlucky ones that retired in 2000 and you did not have a plan on how you're going to pull the money out, you are in serious trouble right now, as you have really seen your nest egg shrink. So this is where I specialize on how to draw an income in retirement without running out of money. And what it takes is you need to divide your money up into 3 buckets. So you have the now bucket, which is your emergency money. It's in the bank. It's not earning a whole lot of money, but it's safe, and you can get to it just at the drop of a hat. Then you have the soon bucket, and the soon bucket is your dollars you need for the next 10 years of income in retirement. And we can invest the money a little more aggressively than a savings account, but our goal is about 3 to 4% net of fees. And we do not want wild swings in the stock market, but this is where we're going to be pulling our money from. And then we have the later bucket, and the later bucket is for growth. And we don't need to touch this money for over 10 years. We know that it's going to go up and down because it's in the stock market, but we're going to give it time. And if we're not having to pull money from that account, we're doing fine. When you're having to sell shares as the stock market is dropping, you're having to sell more and more shares to get your $2,000 a month, whatever it is that you're drawing. And that is what is hurting you so badly. Then as the later bucket makes money, we take the profits and we start to move it over into the soon bucket to replenish that bucket. And this solves the problem. But you need to have this plan in place within about 5 years to retirement, so that it is in place that if you have a huge market collapse and your 401k gets turned into a 201k just about the time that you were fixing to retire, not good. And so this is really, really important to appreciate what needs to happen. And see, more and more people are having to deal with big sums in the 401k. It used to be we could work for a company for 30 years, retire with a wonderful pension, and if you're with the government, that still happens. But more and more companies are getting rid of their pension plans because it is costing them a fortune because everybody is living so long and the stock market keeps crashing. So now they put all the onus on us, and we've got to manage our money and figure out how to invest our money and how to draw an income. And that can be a challenge, as you can see from these slides. All right, back to taxes again. Now, if our marginal tax bracket, if that's all there was to it, that would be really simple. You know, you'd calculate your numbers and plug it into the chart, and there's your tax bill. Unfortunately, that is not the real world. Now we've got required minimum distributions to deal with, capital gains that I touched on, Social Security benefits, Medicare premiums, Roth conversions to large withdrawals from IRAs we have to contend with, 3.8% net investment income tax when we get above $250,000 on our capital gains, and the alternative minimum tax. This is the other way that you calculate your taxes. And if we have large gains, a lot of taxable income in that regards, we can get hit with alternative minimum tax. So this all really complicates the return. Then Congress keeps changing the rules. And late in 2019 was the SECURE Act, setting every community up for retirement enhancement is what the SECURE stands for. And some of the important ones that we need to consider is that required minimum distribution age. This is RMDs, or where you pull money out of your IRA. They force you to. And it used to be at age 70 and a half and beyond, you have to start paying taxes on part of your IRAs. Well, they have upped that a year and a half to age 72. So you can wait a little longer now before you are forced to pull out. Now, also, you can contribute to an IRA after age 70 and a half. It used to be that once you hit 70 and a half, that is done. You cannot add money to an IRA, but now they're saying if you've got a job, W-2 income, you have to have earned income. So Social Security, pension income, IRA withdrawals, that is not income that will allow you to do an IRA. You have to be working for somebody and get a paycheck. But if you are, you can contribute to an IRA after age 70 and a half. They've expanded it now on the 401ks because they're wanting to make sure that more people can get covered. And so part-time employees will have access. And they're allowing people to have penalty-free withdrawals for birth or adoption of a child. I wish this had been around when I was adopting 3 kids. It would have been nice. And then they are giving options that you can annuitize your 401k to give you a pension, guaranteed income for life. So these are important benefits. Some other changes now through COVID-19 that has just come out is that they are waiving us having to take required minimum distributions this year. So that is a wonderful benefit for taxes. And so if you're wanting to do a Roth conversion from IRA to Roth, that'll give you more money, that you can do this. And this is a great strategy. When you have a big IRA, 800,000, a million or more, that is a tax time bomb. And really, we need to be looking at that way before you ever reach the age of 72 to start getting the taxes paid on that. We've got some of the lowest tax rates we have seen in history. You want to pay the taxes now on these accounts if you're in a reasonable tax bracket to do it. So that once you get to 72, now it's in a Roth, it is compounding completely tax-free from here on out, and they won't force you to take a required distribution on that, and life is good on your IRAs. And then you won't get blown up with having to take a $50,000, $60,000 required minimum distribution, and it blows you up in a high tax bracket in later years. So this is huge and really, really important when we focus in on this. We've got a really neat program that I can plug in your tax return and show you how every single dollar is being taxed. And this is an eye-opener over here, and I'll show it to you live here in just a minute. But whenever we do these workshops through SOFA, they require the instructors to offer a no-cost consultation to every person that attends the webinar or workshop. And this is where you can come in to see me with your tax return, and I can plug it in and show you what's going on. And then we can strategize when you retire and when to actually start doing Roth conversions and how to reduce your taxes. A lot of financial advisors don't look at taxes in tandem with their investments. They have to be hand in hand. We've got to look at them together. Now, I don't want you to say, I've already got a financial advisor or a tax preparer. That's okay. I am doing this through a nonprofit. Whether you choose to work with us or not does not matter. I want to spend that hour with you and let you see this. And this is a wonderful opportunity for you to see what is going on your taxes. Now, how do RMDs work? Required minimum distributions. So I had Candace, my office administrator, send you this in an email. And this is a 2020 tax reference guide. And so it shows all the tax brackets for married filing, jointly, singly, and separately, and so on, what the standard deduction and all the different codes are. Really interesting sheet to be looked at. But if you flip it over, you will see the uniform lifetime table. This is the table that you need to use to calculate what your required minimum distribution is. So now at 70 and a half, the life expectancy says 27.4. So in this example, and this is based on last year, We've got a balance of 500,000. This individual's just turned 70 and a half. So we divide the 500,000 by that 27.4, and it comes out to 18,248. That's about 3.6%. At 72, you can see here the number is now 25.6. That works out to a 3.9% draw of your total of your IRAs. And as you get older, you've got to pull a larger and larger amount out. Another change that happened on the Secure Act is that when you leave an IRA to your kids, with your spouse, that's not a problem, but for the kids, you go to another generation. It used to be that they could do a beneficiary stretch IRA and just take a required minimum distribution each year out and continue to defer this IRA for the rest of their life. That is gone. Now, 10 years is the max, and they have got to get all the money out of that IRA and pay the tax at their tax rate. So if you have kids that are doing pretty good for themselves and you've got a big fat IRA, yes, it's wonderful to inherit that, but you are passing a massive tax liability on to them. Doing a Roth conversion can be a huge benefit not only for your taxes, but for your kids' taxes. How would you like to have had a $500,000 tax-free account left to you and be able to keep it in that tax wrapper for 10 more years before you had to pull it out? Huge. This is one of the strongest estate planning vehicles that we have right now. Here's the table. That table I'm showing you in the back of the sheet over here as well. Social Security, let's talk about that for a minute. So is Social Security taxable? And I'll get answers no, yes, maybe. All three answers are correct. Social Security is tax-free if your income's low enough. But once you get to a provisional income, they call it, Uncle Sam says, oh, you're making lots of money, you can start paying some taxes on your Social Security. And they said for every dollar you make above this, add 50 cents of your Social Security and pay taxes at whatever tax rate you're at. Then you hit a second provisional income. And they say, now you're really making big money. You can add 85 cents for every dollar you make above this. And this continues until you have added up to 85% of your Social Security. So they give us a break on 15% of our Social Security if we've got enough income. Now, these provisional income limits come in really early. You do not need to be making lots and lots of money. This is hitting the majority of folks out there. The formula for calculating the provisional income is half of your Social Security plus all your ordinary income, plus dividends and capital gains, and even non-taxable interest. This is all for municipal bonds. Tax-free municipal bonds are included in this calculation to ultimately force you to pay taxes on your Social Security. So let's look at this. So here is filing jointly. You hit the 50% provisional income at $32,000. It's nothing. And you hit the 85% at $44,000. So let's look at an example of how this would work. So here is an individual. They're in retirement, well, a couple, and they're drawing $20,000 of Social Security. They need $60,000, so they're drawing another $40,000 out of their IRA. What is their provisional income? What did the formula say? Half of Social Security, so $10,000, plus all my other income, $40,000. My provisional income is $50,000. All right, the first level was how much? $32,000. So 50 minus 32, we're $18,000 over that level. So we multiply 18,000 by the 50 cents. And so we've got to add $9,000 of our Social Security to this and pay taxes on it. But we also have broken past the second threshold, $44,000 by $6,000. And so we need to add another 0.35%. 0.5 plus 0.35 gets us up to the 8.5. And we got to add another $2,100. So we total all that, and we have to pay taxes on $11,100 out of our $20,000 in this example. 55% of our Social Security. The max this person would ever have to do is 85% of that $20,000 if they had a little higher income. Let's look at a second example. Here is some folks who waited later to start Social Security. Maybe both parties were working, so they have a $40,000 Social Security check. This couple also needs $60,000, but now they only need to pull $20,000 out of their IRA to hit their level. Well, what is their provisional income? Half of Social Security, which is $20,000, plus their other income is $20,000. Their provisional income is $40,000, lower than what we saw here before. Well, 40 minus 32, we're over $8,000, so we got to pay taxes on $4,000. We are not over the $44,000 second threshold. So all we have had to pay taxes on out of all of the Social Security is $4,000, 10%. Huge difference here. Now, when should you start Social Security? When you look at all the calculators and they say, well, the break point is about 81, 80 years old, that you've got to live above this before it's going to be worthwhile for you to delay versus taking it early. How early can you start it? 62. What's normal retirement age? 67. What is late retirement? 70. And so anytime during that period of time, you can start Social Security. If you take it early, you lose about 7% per year on your check, and it's permanent when you start. If you start at 62, you get a smaller check by quite a bit, and it will permanently be lower. But you will be drawing for several years versus the one that waits till he's 67. If you delay, you'll actually get about an 8% raise on your check to age 70. But what I never hear is, what about the tax benefits of having a big Social Security check? And this example shows it in plain daylight, how beneficial it is if you've got a big Social Security check and you don't have to draw as much from your IRA to get the income amount that you want. And you end up paying far less taxes. So here's the first example, $11,100 we had to add of our Social Security from that calculation. We had another $40,000 of other income. So our total taxable income is now up to $51,100. They are over 65, so they get an increase in their standard deduction to $27,000. And so their net taxable income now is $24,000. Pay Uncle Sam $2,511. Whereas on the other one over here, they only had to add $4,000 to their $20,000. So all their income was $24,000, half of the income here. And their standard deduction is more than that, and they ended up with a zero tax return. So yes, they waited and to start their Social Security and got bigger checks. But now they are benefiting by paying $2,500 less in income versus if they had started early and taken a much smaller check. That is a huge example there. Well, most of you have probably seen this. This is your estimate on Social Security. They're sending these out every 5 years now. Or you can go to ss.gov. socialsecurity.gov and get your estimate. And so it'll show you your primary insurance age amount. That's at 67. This is if you wait to 70, and this is if you started at age 62. And they calculate that by your best 35 years. You need to have at least 10 years to qualify for Social Security. But if you have more than 35, then they start dropping off your smaller years and replacing it with better years if you're still working, making good money. And that's how they calculate your Social Security check. A quick example here, if on Jeremy and Samantha, if Samantha has not worked at least enough for the 10 years to qualify for Social Security, will she get a Social Security check? And Jeremy and Samantha are married. And the answer is yes. She will get half as much as what Jeremy gets for his primary insurance age. So if they both waited for filing at full retirement age, and for them it was age 66, it's now moved up to 67, and they both start their check, Jeremy gets $2,200 and Samantha gets $1,100, and it's guaranteed for the rest of their lives. Now, as soon as one of them passes away, the lower check drops off and the surviving spouse gets the larger check. So if Jeremy passes away first, Samantha will lose her $1,100 check and she will pick up the $2,200 check for Jeremy. This is another very important reason that in a husband and wife situation, we want to maximize the highest bread earner's Social Security check. And I've talked to a husband and wife in my office before and trying to get this point across, and the husband's wanting to start his check really early and he's the higher breadwinner. He says, if I make it to 75, I'm going to be lucky. I said, well, what about her? Oh, she'll live to 90. Well, then we need to maximize your check because she is going to continue to get your check all the way to age 90. And so it is really important. And so it could behoove Jeremy and Samantha for him to actually delay all the way up to age 70 before he starts his Social Security check because of that. All right, so we've looked at all these marginal tax rates, but what is your effective marginal tax break? What is the real taxes that you are paying? So here with the tax map that we showed, 0, 10, 12, 22, 24, and so forth. And let's look at a real life case study. Now, I am almost certain that there are a few of you out there who are watching this, that your tax map will look very similar to this, because this is not some unique example over here, as you will see. So John and Jane, they are married, filing jointly. They're just over 65. They have been both bread earners, and they are now drawing their Social Security, and it's totaling $60,000. They have investments in stocks and real estate and so on, and they've got $15,000 of long-term capital gains to show in the tax return. And he is over 70 and a half, and he's having to take his required minimum distributions, and it's totaling $45,000. To have $45,000, you've got to have IRAs totaling between the two of them of a little over $1 million. And that is not uncommon at all. So here we are with this situation. Let's look at what their tax map looks like. So here's the normal tax map, 0 tax for the standard deduction, then 10%, 12, 22, and then ultimately 24. Their tax map is this in gray. What? So we've skipped the 10 and the 12 all together. And here, barely at $11,000, they're jumping into the 18.5 tax bracket, then to 22, and then 50% tax rate for about $5,000, $6,000, and then it finally drops back down into the 22% tax bracket. What is going on? And this is not a ton of income, but they have got a chunk of money here that they are actually paying a 50% marginal tax rate on. So what is going on here? How did this happen? Now, what you would intuitively think is that, let's say, I'm going to go back. You are right here and you earn another $1,000. Let's say you take out $1,000 more out of your IRA right at that point. You would think, well, I'm in the 12% tax bracket. I should be taxed at 12%, right? So we go back over here. So intuitively, you would think 12% on $1,000, and that's $120. Well, here's what really happened. So yes, you withdrew your $1,000. You were in the 12% bracket. You had to pay $120. But you were in that provisional Social Security window. You make an extra dollar, add 85 cents of your Social Security, and you got to pay taxes on that. So we pulled out $1,000. We had to add another $850 of our Social Security and pay taxes on it at 12%. Then we had that, that 15,000 capital gains. Well, if you're in the 12, 10, or 12% bracket, you pay zero tax. But as soon as you get up into the 22% bracket, pay 15%. And as it turned out, right at that wall is when we make a few more dollars in there, and it is now pushing our capital gains over that 22% threshold. And all of a sudden, we got to pay taxes on our capital gains. So we had an additional $1,850 of income. We had to include now $1,850 of capital gains, pay 15%, $277 more, total all that up, and we're up to $499.50. Whoa! And this is happening all the time on lots and lots of people. And unless you got this software that can show that tax map, you don't even know it's happening. And so that is what is so powerful, if we can pull up your tax return and show this to you. And then we can do what if scenarios. Say, all right, you retire, and here's your estimate of what your Social Security is going to be like. Here's your pension and capital gains that we think that you're going to earn. Here's what your tax map looks like. And it may be really ugly. And said, all right, we got to do something about this before you get to this level. And here's what you can do about it. So, number of tools we can do. And I've really been homing in on this Roth conversion issue over here. And then using certain tax efficient stock funds versus regular mutual funds that can give you phantom capital gains at the end of the year that you didn't even know were going to hit you. All of these are important. All right, I want to share my screen over here and show you something here. Sign back in, it timed out on me. Show you this example. All right, so hopefully you can all see my screen. And here is the inputs for this. This couple have now retired, and they are not on Social Security, so no Social Security income. And he's living totally off of his IRA. And so he has pulled $50,000 out of the IRA to live on. So here's his tax map. We've got the $27,000 of standard deduction because they're over 65. Then part of the income was taxed at 10%, and then part of it here at 12% to get up to their $50,000 of income. So their total tax bill ended up as $2,372 in this example. And so his effective rate, or what is the average I'm paying on all of my dollars over this period of time, on the 50,000, that is a 4.74% effective rate. That's not bad on $50,000 of income. All right, now let's change the scenario. And now they're going to start Social Security. And they're going to bring in $35,000 of Social Security. They still need $15,000 to live on, $50,000. So we're going to pull just $15,000 to supplement their Social Security to give them their $50,000. here's what their new tax map looks like. And you'll notice over here, you see this mountain? That is the Social Security. Right here is where you hit that provisional income, where you start having to add Social Security dollars and pay taxes on it, all through that. And then right here is where you finally have included up to 85% of your Social Security, and they finally leave you alone, and you fall back in the 12% bracket again. But then, boom, you're back up in the 22% bracket much sooner. And the reason is because all this gray Social Security dollars turned into income. And so it moved our 22% bracket all the way to here. But look at where our dot is. It's over here to the left of the mountain. So we have paid 0 taxes. Isn't that interesting? Same income, but we don't have enough income to start having to pay taxes on anything. So you go to H&R Block and they do your tax return, and they said, Mr. and Mrs. Smith, we have really good news for you. You owe 0 taxes. And you say, wonderful, this is great, you're wonderful. And so this is going on for 5 years until you attend a webinar that shows you what your tax map was. And suddenly you find out that you could have drawn another $7,700 in income out of your IRA every single year, tax-free. Or you could have been converting $7,000 every year of your IRA to a Roth, completely tax-free. And the opportunity is gone. And to be fair, H&R Block is not set up with a tax map to be able to show you this, to be giving you tax advice. And they wouldn't have known exactly how much room without actually seeing it here. But it is so plain and simple that we can see we need to do a Roth conversion this year. And you've got $7,000 of room that we need to convert. And it'll be at 0 tax. And so we're coming out of a tax deferred environment that you owe taxes on, and you can move it to a Roth, and now it's compounding completely tax free. That is a huge benefit of being able to see this. Let me go back over here to the slideshow again. So in conclusion, your personal tax map varies greatly based on your personal circumstances. And it's really fun to plug in everybody's numbers, because sometimes I'll see a tax map that says, I've never seen that before. I got to figure out what's going on. And that's been exciting. But since we started to do taxes for clients, and we average about $175 is what a tax return runs, at least is our tax lady. We've got 4 advisors and 3 support staff. We really are focused on helping our clients all throughout retirement as we help manage their money and deal with the taxes. But I want to really strongly recommend that you take advantage of the appointment. If you're uncomfortable about coming in face-to-face with a mask or whatever, we can do a webinar, just like I'm doing now, but it is so much better if we can be in the office. We'll be 6 feet apart, and we can do this session. I love this quote: anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury. There is not even a patriotic duty to increase one's taxes. Folks, thank you very much. I was able to keep it under an hour. One drawback, though, of this is being able to take questions as I can in the workshop. I know you've got questions. You can email them to me or keep them until you come in for your consultation, and we can answer all of your questions. I hope this has been really enlightening and open up your eyes to the craziness of our tax code and how important it is to have the tools to be able to see how you're being taxed and to have a plan to structurally get your IRA taxes paid and to keep you in the lowest tax bracket possible. We are in some of the lowest tax rates we've ever seen in history, and the government is spending trillions of dollars. Guess what? That will have to be paid through taxes, which most likely we will see tax rates going up in the future. So if that's the case, pay your taxes now on your IRAs and lock in a low tax rate. Thank you so much for being on the call. Bye-bye now.